You probably pay for Netflix, and so does everybody watching this video right now. Every month, hundreds of millions of us hand our hard-earned money over to Netflix. We watch the shows, and we'll do the exact same again next month. But what if you owned Netflix instead of just paying for it? One way, money is leaving your account, and the other way, your money is working for you. Because Netflix just fell nearly 50% from its all-time highs of $135 a share, sitting at just $68 today. That's 280 billion in market cap gone in just 6 months. So today, we settle it. Keep watching Netflix or buy the stock and build wealth from something that you are already paying for every single month. So today, we're going to explain 3 different things. Firstly, exactly why Netflix stock has crashed. Secondly, why we do not believe that Netflix is a broken business. And third, why we believe that Netflix can post an easy 20 to 30% return over just the next 6 months. This beats your S&P 500 retirement plan, right? Netflix has reset from a high-growth subscriber land grab story into something completely different, a long-term compound. And here's what most people are missing. We think the bull case is now stronger at $68 a share today than what it was at $135 a share. BlackRock still owns 24 billion of this stock. Vanguard owns 19 billion. They haven't left yet. So why is everybody else panicked? Guys, now we're going to run through the bear case and 4 things that have heavily hit the Netflix stock price over just the last 3 to 6 months. Number 1, revenue growth. And guys, what we're going to look at here now is what we have on screen, our earnings report. Netflix has grown at about a 20% compound growth average over the last 10 years. And what you can see on your screen there is in the last 4 quarters, 16%, 17%, 17%, 16%. That number just dropped to 13.4 in Q2. And management is guiding to 12% for Q3. Now, growth investors hate that, and a lot of them have left. But ask yourself, is 12 to 13% growth actually that bad? Netflix at $68 a share is growing 12 to 13%, versus Netflix at $135 growing at 20%. So which is really the better buy here? The stock now trades at 5 to 6 times revenue. It's used to trade at about 12 times. That's a brutal derating for what is honestly only a moderate slowdown. So guys, the second thing that has impacted Netflix stock price is the Warner Bros. Discovery bid with Paramount. Back in December, Netflix went head to head with Paramount for Warner Bros. Discovery. And Paramount kept sweetening the deal until the offer won. Now the market read that as Netflix scrambling for content and losing. We read it completely differently. Netflix had a 4-day window to match Paramount's bid, and they could have, but they walked away, rather than overpay for a debt-loaded piecemeal studio. Now that's discipline, not defeat. Number 3, live sports. Fights like Tyson, Katie Taylor, and Tyson Fury. They're being read as a defensive move, a paywall to stop churn, not real growth. This is entirely wrong. We believe the market has got that backwards, and we'll prove it to you now in a minute. And guys, the 4th issue that is impacting the Netflix stock is disclosures. Now you'll see it here on my screen. Netflix is cutting its viewing hours reports from twice a year to only once a year, starting in 2027. And on its own, that's fine. But paired with a guidance missed in its latest results, the market took it as a red flag on transparency. So guys, there are the 4 bear cases. And we don't think a single one of them is fatal. Now let's jump into the bull thesis. So our first point here today is on pricing power. This is the single biggest part of the thesis. Netflix has raised prices again and again and again, with almost no impact on churn and no subscribers leaving the platform. And why is this? Netflix has a sticky user base, a massive library, and a monthly price that's still cheap for the hours of entertainment you get. This isn't a business that needs millions of new subscribers every quarter. It can just earn more from the ones it already has. Higher prices, minimal cancellations means higher average revenue per user. Expanding margins and EPS growth that will outpace revenues. And this lever is still underused outside of the US. The recent US, Mexico, and Spain price increases only captured a partial quarter in Q2. The full annualized benefit is still ahead. Think about it, even a moderate price hike means absolutely nothing for the people paying. It is still a cheap night of entertainment for the whole family. And honestly, think of it this way, it is a cheaper form of childcare. Point number 2, advertising, the new growth engine that nobody is pricing in. Ad revenue is on track to roughly double to $3 billion in 2026. Third-party estimates put it at $6 billion by 2027 and $10 billion by 2030. So ad revenue grows from about 6% this year to about 15% within a couple of years. And ad tier subscribers are projected to hit 76 million subscribers by 2027 and 100 million by 2030. And the plan here is to expand into 15 new countries. And here's the key, this is high margin revenue riding on ad infrastructure that's already been built. One bare point was that the operating margin in the recent earnings dropped 70 basis points alone. Now, imagine that number when ad revenue scales and margins expand 200 to 300 basis points alone, just on ad revenue. Point number 3, capital returns. Netflix bought back $4.7 billion of stock in Q2 alone. Its biggest buyback quarter ever, with $27 billion of authorization still left. That's roughly 10% of the entire market cap. Every dollar spent buying back stock at $68 a share instead of at $135 retires twice as many shares for the same money. If EPS comes in at $4 a share this year, but the share count shrinks 10% from buybacks, you're not looking at $4 a share. You're looking at $4.40 per share. And that's a major EPS surprise that beats street targets across the board without a single new subscriber. And point number 4, content is expanding the moat, not signaling desperation. While live sports made up just 1% of total view hours, it drove 6 of the top 10 sign-up days over the last 5 years, on only about 5% of content spent. Now that's an efficient acquisition tool, not a defensive one. Now, layer in video casts, creator partnerships, and cloud gaming. Engagement levels that didn't exist 2 years ago, on top of a scripted and film slate that's still producing global hits, like Stranger Things, Wednesday, Bridgerton, Virgin River, Black Mirror. These are own franchises Netflix can continue milking with new seasons and spin-offs. This is going to lock in whole new audiences where they can't get the content anywhere else. And guys, looking at our earnings report here, I am going to prove to you point number 5, that the valuation is reset faster than the business has changed. Now, if you think Netflix is dying, explain this. Every single region grew double digits last quarter. You can see here, UCAN is up 10%, EMEA is up 14%, LATAM is up 21%, and APAC is up 16%. And yet, the stock trades at $68 a share, down 45% from its June 2025 highs. At a forward PE of around 20 times, well below its historical norms of 30 to 40 times. The guidance from here, 13 to 14% revenue growth, a 31.5 operating margin, more than 20% upside on operating income. These numbers, this guidance, this does not describe a broken company. This describes a normal maturation process with Netflix getting punished like its collapse. Free cash flow is guided to a new all-time high of $12.5 billion, when the old all-time high was $9.5 billion. Yes, $2.8 billion of that does include a Warner Bros. Termination fee, but strip it out and this is still record revenue and record EPS. Now, does that sound broken to you? Guys, first things first, let's look at our price target we have here on screen. We've taken an approach of only looking 6 to 12 months from now. So we do think this can go a lot higher. The free cash flow is suggesting that it's at all-time highs. Why we are only forecasting 6 to 12 months from now is because that's what our audience focuses on. We believe Netflix can do an easy 25% in the next 6 months. Free cash flow at a high, revenue at a high, net income at an all-time high, and management are now setting records on buybacks. This is the perfect setup that we love. The only thing that has changed is market sentiment. So guys, here's the thesis in just 3 lines. 1, growth has slowed, but it didn't stop, and the market punished Netflix like it stopped. 2, Netflix walked away from an overpriced bidding war instead of destroying shareholder value, and they got paid $2.8 billion to do so. 3, pricing power, ads, and share buybacks. These are 3 separate engines that can drive EPS much higher, and they don't include anything to do with subscriber growth. They can do it alone. So guys, Netflix isn't broken. It's transitioning from a high growth subscriber story into a cash generating, capital returning compound. And that transition is happening at exactly the wrong price for everyone selling and exactly the right price for everyone buying. At $68 a share, with pricing power intact, ads scaling, buybacks retiring shares at a discount, and every region still growing in double digits, we think Netflix deserves a place in every long-term portfolio. So back to where we started. You are already paying Netflix every single month. The only question is whether you want to keep being a customer or start being an owner. This isn't a trade, it's a decade-long compounder on sale right now. Of course, this is not financial advice. You should always do your own research. We are just here to assist you, and we care about the retail investor. But if this changed how you think about that monthly subscription, hit like, hit subscribe, and tell me in the comments. Is this a level that you would be comfortable buying Netflix at? And guys, thanks for joining today. We will see you in the next one.